Hey everyone, it's Matt Donahue with Mission Financial Planners. I'm one of the managing members here at Mission Financial Planners. I am also joined today by Kenneth Hamilton, who is a managing member here, and Jason Dufault, who is also a managing member. We, between the three of us, founded Mission Financial Planners. Ken and I first founded it back in 20. Jason joined the team in 23. And our goal, our mission at Mission Financial Planners is to really empower people to help them make informed financial decisions so that they can get to where they want to be. And that's not just from a financial standpoint, but it's also from an emotional and a legacy standpoint as well. So the purpose of this episode, we're going to break down today's 2025 key financial data card. We mailed this card out to a lot of people. All of you have also received this card via email as well. Or at least if you're on our email list. If you haven't received a copy of this and you're watching this on LinkedIn today, feel free to reach out to us directly. We can get a copy of this over to you as soon as you want it. So, guys, we're going to talk about three key things on the data card today. We're going to talk about tax changes and planning for 2025. We're going to talk about retirement planning updates. We're also going to talk about investment and wealth building strategies, and then we'll wrap it up. Last thing here before we jump into it. So guys, take 30 seconds, just introduce yourselves real quick. And then Ken's going to hit us up with some ideas for podcast names because this is our first podcast recording ever. And we're excited. We just don't have a name for our podcast yet. And so, maybe the cart's before the horse, but who cares? Let's just do it, right? The first one's always the worst one, right? So, but Jason, go ahead, start and introduce yourself quick. If you could, when you introduce yourself, tell us one true thing about you and one not true thing about you and see if Ken and I can figure out which one's which.
Oh, not true. Okay, that'll be a tough one. So I'm Jason Dufault. I'm one of the managing members here, CFP, Certified Exit Planner, Chartered Advisor in Philanthropy, Certified Fiduciary Plan Advisor for 401ks and retirement plans for business owners. One true thing about me is it took me 5 years to finish my undergraduate degree. And then the other true thing, and you'll figure out which one is right or wrong. The other true thing is I did some postgraduate work.
Okay, I'm going to believe that it took you 5 years to do the degree because you bootstrapped it. Like you had to work and everything while you were going through school. So I'm going to believe that one. Ken, what do you?
Well, I could also, I'm going to say that the lie is that he has not done postgraduate work because while he has a ton of credentials and such, this guy, when he starts something, he finishes it. So.
Yeah, there's got to be at least one class in there, right? Like one graduate level course in there, at least one.
So the true one was the first one. You're right. That it took me 5 years because I did bootstrap. I didn't have to work and do everything else while trying to get my finance degree.
Awesome.
Hey,
awesome.
What I would do for a victory lap, man. Good for you.
All right, Ken.
Well, everybody,
you're up.
Kenneth Hamilton, pleasure to meet everybody. A San Antonio native. Can't believe it, but I am in my 15th year in the industry. Where does the time go? I really enjoy working with families, households, seeing what's possible, getting them to reach their highest horizons. And you can do that not just through investments, but through taxes, which is primary conversation today, but through estate planning and knowing all the different tools that are out there and really finding the right combination for them. And so starting there and seeing where it takes us. So the truth and the lie. So one truth is that I've performed live with the band Chicago. The other truth is that I have been to 5 different continents.
That's a tough one. I'm going to say you've been to 5 different continents. I'm going to say that's the truth. Jason, what do you think?
I think the first one is the truth.
Well, yeah, you got us confused.
So I have actually performed live with the band Chicago.
No kidding. You met Peter Cetera?
I have, and I have shook the hand of Peter Chiavarelli, the manager of the band Chicago, multiple times. Long story short, I went to the University of Notre Dame. I was in the marching band, And Chicago has a very close relationship with Notre Dame. And Peter Chiavarelli is the godfather of the marching band. He would send us cheesecake randomly after practices and such.
Very
But
cool.
One of the halftime shows, Chicago performed halftime, and we were there playing 25-6 to 4. Does anybody know what time it is? And Saturday in the park. And so I was on the
Wow.
field with the band Chicago.
That's fantastic. That is super cool.
Yeah. And so I still need South America and Australia.
Gotcha. Okay. All right, cool. All right, guys, we're going to jump into it. So first part here, tax changes in planning for 25.
Do you want the
Ken,
podcast?
you're up.
Well, do you want the podcast names?
Oh, yes.
So I have a list of about 15 in front of me. I'll pick some of the ones I like the best. So these are potential podcast names. Please throw it in the comment if you like any in particular. The first one that stuck out to me was Mission: Wealth. Okay. Another option is Your Money, Your Mission, and then MFP Money Minutes.
Yeah, they all sound good. We'll see what people say, right? We'll see what people say. Cool.
I interrupted, so.
No, you're good. And you're up anyways. Ken, you're going to lead this part of the conversation. We're going to talk about the 2025 tax rate schedule. And I'm zooming in a little bit so people can kind of see it. Talk about tax brackets and deductions, Ken. Like, what are the big things people need to know?
So the first thing is, with how inflation has been trending, that as things have gotten more expensive, wages have increased, so have the tax brackets, at least when we're looking at federal income tax. Though you may have gotten a raise and you may think you may be in a higher tax bracket, there's a pretty decent chance that the tax brackets have grown with your wages and kept you in that same spot. The thing that a common conversation I have with clients is a friendly reminder that though you are in the 22% bracket or the 24% bracket or even the 32% tax bracket, does not mean you're paying 22% on every single dollar. We live in a progressive tax system where the very first dollar you make is technically tax-free because of the standard deduction. Now, depending on if you're married or single, determines what that standard deduction ultimately is. And also, if you are older or you have some disabilities such as blindness, can actually give you a larger standard deduction. So the first dollar you earn, completely income tax-free. After that standard deduction, the next dollar after that, you can see is at the 10% tax bracket. And that goes all the way up to, at which point you would then be paying $2,300, again, for that first 10%, from 0 to 23, 10% on that. And then the next dollar amount, you're paying 12%. And then the dollar above 6,000, well, then you're paying 22 and then 24. So another way to think of it is, even though you're in the 24% tax bracket and you made that 206,000, you only paid only paid 35,000 in federal income tax, which is closer to an effective rate of about 17%. So one, understanding your tax brackets, super important, but also understanding what your effective tax rate is equally important.
You want to talk a little bit about deductions and how that works? I think there's always some confusion about, should I itemize? Should I, is it worth saving receipts because the standard deduction is so high now? Mm-hmm. Can you talk a little bit about that?
Absolutely. So because the standard deduction is so high, a large part of that is to the TCJA law that passed a couple of years back that gave us the larger standard deduction. So very few of our clients are doing itemized deductions. And that's where you do keep the receipts of your donations and your medical bills and your home maintenance, and you add all that up. If that dollar amount is larger than your standard deduction, well, then you're going to itemize. Now, right now, the TCJA Act is scheduled to sunset. Now, with the administration change, all indicators are pointing that they're going to extend it. But until it happens, it hasn't happened. It is scheduled to sunset at the end of this year. So next year, you're expected to have a reduced standard deduction. And so honestly, it's good practice. And I'm doing this myself, is keeping track of all of my expenses more closely because I'm anticipating to be doing itemized deductions next year, where this year and the previous year I had relied on the standard deduction. But as you can see on the screen, is that if you're married filing jointly, your standard deduction is $30,000. So thinking back to my other thought was that the first $30,000 that your family earns is completely income tax free. Now, where things can get a little interesting, we work a lot with retirees, is that while a lot of our clients may enter retirement married, sad reality is that they are likely to exit retirement in the single brackets. That is because due to death and the potential of a silver divorce as well. And so while you
So
may,
question for you, not to interrupt, but question for you,
please,
Ken. So we're looking at the single brackets here, right? If you were a married couple and you were making, call it this 394 number down here, right? And now your spouse dies, once the time limit runs out on you being able to file MFJ, married filing joint, and now you're filing single again, does people's income tend to drop that significantly when one spouse dies?
yeah, we've had so many conversations about this. And people are like, well, there's half as many people, so my expenses are cut in half. And it's like, well, no, your property taxes stay the same. Yes, your food consumption goes
And not to
down.
interrupt Ken, but you got 20 seconds to
All
wrap up
right,
before we go on to the next topic.
fair enough. Food consumption goes down, but then you have to think about all the chores and tasks that they do around the house. So if they were taking care of the lawn maintenance, that's now on you. And where's that expense going to come from? Typically, we expect a household to see about a 20% reduction when one of their partners go away. But yeah, if and when your partner switch to a single bracket, you're now likely going to be in a higher bracket uh, in taxes and everything else. So it's something to be thinking about going into your retirement.
So tax planning doesn't stop in retirement. It's every bit as important in retirement. So Jason, one spouse has passed away, right? Or both spouses are older. They're starting to think about gifting. They're starting to think about the estate tax. Because one of the things we've seen over the years is, when people make the transition to retirement, a lot of times they're really concerned about, oh my gosh, I'm retired now. It's a big change, and it takes them some time, anywhere from a year to 2 years to really get comfortable with the fact that they're retired. They're living this new lifestyle now. But then they start thinking about gifting, right? And that tends to be when the conversation really picks up. What are some of the issues you see? We can see the numbers here and all that, but what are some of the issues you see with the gift tax limits and stuff like that? Like, do you think people really understand how this system works?
I don't think so from what I've experienced over the 20 plus years of doing this. I think they understand there's a gift tax exemption or exclusion, excuse me, of the 13,990, which has been going up pretty good. It's been going up over 300,000 a year for the inflationary part they put in. Uh, but I don't think they know exactly how to use it. Like when they actually look at their situation and say, how do I get some of this money out of our space? Like we have clients we've worked with, are working with now that are creeping into the gift tax position where they have so much money that they're going to pay gift tax or estate tax if they die, right? Depending on what they do. And they don't get the concept of, okay, take what assets do I have that I don't need in my lifetime that I can gift outside of my estate. So it's no longer in my estate for the benefit of whoever I want or whatever I want. Meaning it could be a charity, it could be whatever from that end. And I don't think they understand how that gift part works. And I think when it comes to charitable planning, there's a lack of understanding of how charitable gifting works in the system.
So, so when you look at the gift tax exclusion limits and all that stuff, for a lot of people, and Ken, feel free to jump in too with any thoughts you might have, but when we think about a lot of retirees, they get into retirement, their accounts continue to grow because they set up a great retirement plan, right? And they're not necessarily worried about where their check's coming from month to month, regardless of what the market's doing. By the way, shameless plug for Mission Financial Planners. If you want to find out how you can do that, get a hold of us because we can show you how to do that. For a couple that's not worth 14 million between them, right? A couple that's worth 5 million, And a ton of that money is tied up in IRAs, 401ks, 457s, the traditional ones, not the Roth versions. What kind of estate planning issues are these people dealing with? Well, and maybe while they're alive, but then also, when they are starting to think about end of life.
Yeah, I would say the biggest issue for them, and we see this a lot, is the system tells you, hey, save, 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 put as much as you can in pre-tax 401k, max it out, do all that fun stuff, and end up with $5 million. And the challenge becomes every penny that they take during their life is going to be taxable. So if tax brackets do change, especially considering we're in one of the lowest tax brackets of 3 that we've had in like 100 years. So, every penny they have is subject to the taxation, which means less money in their pocket. The second thing for that is historically, what the numbers say is when people inherit, if I inherit my dad's IRA or my mom's IRA, most people are going to go through that money in less than 18 months. And if that's the case, and I'm inheriting a large IRA because you were an excellent saver, then I could be at the top tax bracket easily because every penny of it will be taxable.
Sure. So, Ken, go ahead. Sounds like you had a thought.
Yeah. The thing that I'd like to add to what's on the screen is to really highlight the annual taxing limit that's been increased this year. It's now $19,000. Now, with a lot of our clients, again, they're doing well. They're RMD. Again, they have surplus income, and they're wanting to pass it on to their kids. And you can give up to $19,000 per person to technically anybody you want without having to file any additional tax forms. But this is per person to per person. So what meaning is myself and my wife, each of us can give $19,000 to our kids and directly into their name without having to file taxes. So we'll round up, we'll call it 20,000 each. That's 40,000. And so you might have some kids or grandkids. You can give 19,000 to one child. Your partner can give 19,000 to another child, and maybe they have a kid themselves. You can again each give more dollars to them as well, and it really adds up in who you give, how you give it. Ultimately, the last thing you want to do is go over this limit and get Uncle Sam coming at you. So knowing where the limits are and the ways to properly navigate it is really key if gifting is something that you actively do.
So Jason and Ken, we have, when you think about gifting and all that, we have couples that in our practice here at Mission Financial Planners, we have couples who they have like this big RMD, right, that they don't need. And if you're not sure what an RMD is, give us a call. We're happy to take you through it. But they have to take money out of their IRA. They're not sure what to do with it. And in a lot of cases, what we do is a lot of like second generation planning with that money, right? Because it's money I don't need. I have to pull it out anyways. I need to get some of this stuff set up. And to kind of set the table for you guys, it's maybe they buy a big survivorship insurance policy on a limited pay basis. That generates a ton of tax-free money for the kids when they pass away. But then they also maybe go out and finance some additional insurance policies that the kids can buy. And once all that's paid for, now charitable really kicks in because it's like I've taken care of myself, taking care of my family. Now I want to start really taking care of the community. Can you guys talk a little bit about that? We got about 45 seconds. Can you guys talk a little bit about, how is it people get to that point where they really start thinking, hey, I have this income stream that I need, that I'm going to get taxed on. I want to do something with it.
Sure. I'll take this real quick. If you go to our website and look at some of our materials, we have our planning pyramid. And it really starts with the base of risk management and being prepared for yourself and generating income. Because, again, you have to have a plan. You have to take care of yourself first and foremost. Then we focus on our investment strategy. And this is more of your lifestyle bucket, if you will. Going on better vacations, making sure you're flying first class, everything else. Kind of much like Maslow's hierarchy of needs. As you start to accomplish these things, more doesn't mean more, but there's still a surplus. And that's once you've taken care of these things, you're rock solid, you're living your best financial life, then we can worry about taking care of your kids, the charities, and everything else.
Jason, final thoughts on estate planning and taxes. 30 seconds.
Yep. Final thoughts on estate planning is everyone needs an estate plan. If you don't have one, the good news is your state has one for you. and it's called intestate, and it may not be what you wanted to have happen, but it's going to be what they want to have happen from that end. So if you don't have an estate plan, if you don't at least have a basic will, a basic power of attorney, basic medical directives, then you need to be talking to someone that can help you with that. We do a lot of that hand holding with our clients as we bring them through the financial planning process to get that stuff done. The big ticket there is most people don't know this, but when I inherit an IRA or retirement plan from a parent, it is no longer a protected asset. What that means is as long as I'm the owner of the IRA and I'm the original starter of it, it's a protected asset under the rules of the state of Texas for sure. Each state's a little different. 401k is a perfect example. It's protected under every state. I can get sued and they can't really come and take my 401k. If I take a distribution, I might be able to take it, but they can't come take my 401k. I pass that asset on to my kid. That's not true anymore. They can come and take it all if they get sued.
So the key is set them up the right way and don't just think about the dollars and cents.
Yeah.
Don't just think about the dollars and cents. Okay, we're going to jump into a conversation now about Social Security and taxation, not just on that, but also on healthcare. We could talk for hours about this. Ken holds credentials in Social Security planning, as do I. We all hold, certified financial planner credentials and all that. We've all done additional training on income planning, and so on. And, I feel like the message is finally starting to kick in a little bit to the average person that your Social Security benefit is an important benefit and it's an important part of your plan, regardless of how you are structuring your retirement plan, right? Even if it's only 10% of your income plan in retirement, that's still 10% of funds in retirement that you don't have to generate. The biggest thing, and the only thing I'll really say about taxation on Social Security is you always have to remember this key part here. And I'm just not going to get into the provisional income formulas today, but you can see here, married, let me get back here so it's centered a little better. So married filing jointly. If you can keep your provisional income under $32,000, which it's doable, but you got to start planning for that in your late 40s, early 50s to make that happen. It's very difficult to do that if you're already 65, unless you're thinking you're going to work 10 more years, right? But for a lot of people, you got to start in your 40s and early 50s if you're really going to do that. But you can get your provisional income under 32,000. Every dollar you get from Social Security in retirement will be tax-free to you. Second thing, you can see if you're between 32 and 44, now half your Social Security is taxable. If you get up over 44, now 85% of your Social Security is taxable. Think about something Ken and Jason talked about earlier, which every dollar that comes out of an IRA is considered income to you. You could literally pull $1,000 out of an IRA to just go on a concert, which is like the little case study we use in one of our presentations. But you could use $1,000 for whatever. It came out of your IRA. Well, folks, if it pushed you over 44,000 on your provisional, now your Social Security is getting 85% of your Social Security is getting taxed in retirement. You didn't just pay income taxes on the $1,000 you took out. You're also now paying income taxes on that provisional income for the next year. So you've got to watch these things in retirement, right? And I'll turn it over to Jason and Ken for their comments and thoughts. Specifically, guys, I want you to talk about like using the blackout period, like alternatives to fund it, because it kind of ties back into RMD planning and all that. But last thought I'll give everyone is if you're thinking break-even analysis is how you're going to make your decision on Social Security, that's the wrong way to go about it. It just is. And the reason why, I've never, in 15 years of teaching Social Security classes, I've never once met someone who was actually able to do a tax analysis on their retirement base, using that break-even analysis where it benefited them. Not one time. So it's not just dollars in the door. It's not just growth, growth, growth. It's also how are these dollars going to come into your household in retirement and how are you going to keep them? So that's kind of a long introduction to 7.5 minutes on, Social Security and Medicare updates. Guys, thoughts on Social Security, thoughts on planning strategies that people should be thinking about that maybe they don't hear about that often.
I'll give a very quick wrap on it. At the end of the day, Social Security is a tax advantaged income source. No ifs, ands, or buts. Definitely on the federal level and in most states on the state level as well. When choosing when to claim, you can have tax benefits on a smaller amount or a larger amount. Best case scenario, as Matt was describing, 100% of your Social Security is income tax free. Do you want that 100% to be smaller or larger? Worst case scenario, 15% of your Social Security is income tax free on the federal level. Do you want that 15% to be smaller or larger? Your choice, but let's talk about it. JD?
Yeah, I mean, that's spot on for what I was thinking too. Along with that, if you can get ahead of this curve and not wait till the last minute with the Social Security planning, then you can actually position where your income is going to come from. There's very few sources that don't affect how much they see when they decide how much is taxable of what you're dealing with. So, and that's what we kind of specialize in, is looking at those sources, trying to design the plan to say where will the money come from so it doesn't show up in your provisional income and you can get the most tax-free reward out of that Social Security that you've contributed for probably many, many years.
So, guys, that we're balancing, and this is kind of a nice segue. We'll talk about Medicare more in a later section, but to kind of wrap up the conversation on Social Security and all that, if you've heard of the Social Security tax torpedo, that's what we're describing to you, is how a dollar out of an IRA can really blow up your tax rate altogether in retirement. So along those lines, when you're doing tax planning in retirement, you need not just to be thinking about your federal income tax. For those of you in the 37 states where you do pay state income tax, your state income tax, you also have to be thinking about what's on the screen in front of you right now, which is your Medicare premiums. This is the means testing for Medicare. We're going to talk about this a little more later in the episode, but where Ken described taxation as a progressive tax system where you don't, the rate gradually goes up, Medicare means testing is done on a cliff system, which basically means if you're that couple we were talking about earlier, where you have between $300,000 and $400,000 of income, each person is paying about $480 a month for their Part B and another $57 a month for their Part D. When that one spouse dies and that income stays in that 330 level, what's going to happen to the surviving spouse is they're going to jump up to this bracket. So when Ken was talking about tax bills, things like that, they don't go away just because one person dies. This is a perfect example of that. So we went a little over on time on Social Security and Medicare, but Jason, retirement contribution limits and RMDs, if you could, I know we have a lot of people, especially since we're live streaming this on LinkedIn. These are IRA amounts. Let me double check. And business owners. Yeah, these are IRA. Here we go. Let me scroll up here. Retirement plan contribution limits. Here we go. Jason, could you take a few minutes and talk about how many business owners you've met over the years who are great at running their business, but they are paying way too much in taxes now and have no savings set aside for when they retire other than eventually selling their business, and how setting up a retirement plan could help them. Could you talk about that for a few minutes?
Absolutely. There's a lot of small business owners that we meet that are exactly what you said. They make a lot of income. They make a large profit on their business, but they're basically saving as a IRA or a SEP IRA, where they can only save a certain percentage of the amount of money they make, and then they have to give everyone an equal fair cut of everything, even though they may be doing most of the work. What we found in working with these small business owners is they don't understand that the code has a provision for them, for small business owners, that says, hey, we understand that you make grossly more than your staff and that you're doing all the heavy lifting, taking all the risk. We do have a provision in the code that says you can save more because of that. And that's where this comes in. When you look at that annual compensation used to determine contributions for most plans of $350,000, they are talking to the business owner there for that part. And when you look at the two parts under there where it says defined benefit plans, basic limit 280, they are once again talking to the business owners for that. We have literally set up plans for business owners that were, after they paid themselves, they were still profiting $200,000, $300,000, $400,000, and we're literally able to take half of that or more and put into a retirement plan where 90% of those proceeds went to them and only 10% had to go to their staff or employees in this case from that end.
So if we boil that down to for a business owner, right? What does this mean though? How do they get the money in there?
They basically go ahead. I'm sorry.
No, go ahead. Go ahead.
They basically set up the plan document in the right way where we can legally tilt more money towards them from that end. And then they start making contributions from their employer monies into this plan and comes directly off their business tax return and or Schedule C if that's what they file from that end. So they literally see a deduction in their income as if they had bought something bought a piece of goods or services that they use to make their product or service. There's a direct deduction off of it.
Okay, so I'm a small business owner. I got $500,000 of income from the business. Okay, what should I do?
If your retirement plan isn't in order, which with most business owners, they're not from what we've experienced, what we should do is do an analysis to say, based off of your age, your staff's age, your income, your staff's income, how much can you contribute to this more sophisticated retirement plan, defined benefit plans to leverage more money towards you? And then determine from there, what does that number need to be to make your situation work? In other words, the number may be 300,000, but that may be too much for you. You may only need 200,000 to make your situation work. Well, great, we'll dial it down. The good thing about these type of plans is you can dial in to the number that you need if you're doing the work to do the planning first to understand what number you need.
So let's say I'm a small business owner who's in a more of a cash flow type of business, right? And so year one, 2024, I have a ton of income. 2025, I don't have as much income. If I'm looking at this 350 and 280 numbers, what I think I'm hearing you say is, hey, at the end of 24, when I've had this fantastic year of income, I can plot a little extra money into it. 25, when the income maybe isn't as good, I don't have to put the same level in I put in 24. I can put in what I can afford to put in 25. Am I interpreting that right?
To some degree, if we do it right, that would be a true statement. So in other words,
Okay.
when we look at your number, there's going to be, this is the normal number for what you said you wanted. If you wanted to contribute more, there'll be an excess or a catch-up number that you can put in, right? And then the next year when it's down, if we're doing our job and we're having regular conversations, I'm going to know that it's down. And what I'm going to do is I'm going to tell the plan sponsor or administrator to freeze the plan.
Okay.
And if they freeze that plan, it means it gives you the autonomy to not make that contribution or adjust the contribution based off of what's going on there with the situation.
Gotcha.
So we've taken business owners that put in 300,000, and then next year they can only do 50,000.
Gotcha.
But we knew beforehand, so we could create the freeze and give them the autonomy to do that, because the next year would be a big year. A perfect example of this are the attorneys that do all of the claims against the trucks that run into people and all of those things. Those type of attorneys, because their income typically volleys up and down depending on what cases close or don't close.
Sure, that makes sense. So the key is then you got to work with someone like Jason, right? Because he's watching this for you. He's proactively reaching out in September or October, hopefully about the same time your tax professional is reaching out to you to say, hey, we need to do some year-end planning here, right? And then that's when you guys are making the updates, right? Because you have a good idea of how the year is going to go, or what the last 2-3 months are probably going to look like. At least most business owners do at that point.
Yeah, we would actually reach out twice, Matt. We would reach out in the April-May timeframe to see where the business is, if it's on track or off track, and then exactly when you said.
Okay. So I know we have a ton of small business owners that we're connected to on LinkedIn. And folks, when we mean small business owners, you might be your own, I mean this in the best way possible, because this was us at one point, right? You might be your own little LLC financial planning firm, and this is out of your wheelhouse. You might be a property casualty insurance agency, and this is out of your wheelhouse, right? I mean, you could be a health insurance agency. You could be a tax attorney. I mean, it's all over the board, right? If this isn't your bread and butter, Jason talked about tort attorneys, right? Tort attorneys know tort law really, really, really well. That doesn't necessarily mean that you're an expert in this stuff. And that's where getting the good advice is going to help. Life insurance and long-term care planning. Okay. from a life insurance, let me just look at the card here and make sure I'm going to the right spot. Jason, before we get there, I know you, when we were getting ready for today, you mentioned you wanted to talk about the importance of HSAs, especially as people get older. My thing on HSAs, and I know you've got some thoughts on this, so, and Ken, absolutely, you need to feel free to interject here too. My thoughts on HSAs is always like, it's great if you're maxing out everything else and you have decent health care, right? To then put some money in an HSA, let it, because once you hit 65, it now acts like another Roth IRA for you. That's just me, okay? Am I discounting the value and the impact of funding an HSA on a regular basis? Am I?
I think there's some things, Matt, that people don't understand about HSAs. HSA is an above the line deduction.
What does that mean? A lot of people don't know what that means. What does that mean?
So if you're not a tax preparer, what it means is you get the deduction before other taxes come out. So think about this. Every time you get a paycheck, they take out Social Security and Medicare tax. Every paycheck, right? Up to the limit, whatever the statutory limit is for Social Security that year that we're in. And then Medicare doesn't have a statutory limit. It just keeps going, I think, indefinitely, is my understanding. So when you make that deduction, that money comes off the top. Then they say, okay, how much does he owe to Medicare and Social Security? So I understand it's a small amount relative to what you could put in your other retirement plans and everything. But the thing about the HSA is a super tax advantage because you get the above the line deduction like I just described. Plus, when you take the money out for medical expenses, like you said, it acts like a Roth. It's tax free for that. Not only, the other thing about it is it doesn't have the age restrictions for the tax free feature. My wife got unemployed, right? Or got laid off. So now she's unemployed. Well, we had to go on COBRA. Well, because COBRA is a health insurance premium I have to pay, technically my HSA can pay that tax free. So whereas I was a Roth, I'm too young to take out a Roth. I'm gonna have penalties, I'm gonna have these things. So it's an extremely good buffer and tax advantage buffer for health related costs. So if you believe you're gonna have any health costs throughout the rest of your life, this might be a good solution for some of it.
No, any health costs. Nobody's going to have any health costs for the rest of their life.
Right?
It's not going to happen. There's no way, right? There's no way. Okay, so that's great. That's like tax benefits, and you'll see here we're showing you the deductibility of long-term care premiums, and you can see Medicare deductibles. Let me back out just a little bit there. Just a couple quick points on this for you folks. So a lot of people ask us about long-term care. When you're getting into retirement age, right? There's 3 big risks you have to manage when you're putting together your retirement income plan. One is longevity, which is what if I live to 105 or my spouse lives to 105? 2 is sequence of returns risk, which is going to segue right into Ken's next comments he's going to make about investment themes. Ken, we went a little out of order today, so I apologize.
You're good.
But we're going to talk about investment considerations next. Before we get into that, though, you also then have to think about your health, because we're all going to pass away. We know that, and mortality becomes real for people at different points in their life. We totally understand that. But the question that should be in everybody's mind is, how am I going to pass away? Am I going to pass away suddenly, or is it going to take me 7 years to die from a chronic illness that I have? What's the impact of the chronic illness? That's why people buy long-term care insurance. Now, the deductibility of long-term care insurance premiums, that is on, you can see it says qualified policies. A qualified long-term care policy has 2 things that a lot of people really don't like about it. One is there is no premium guarantee on a long-term care policy. So like Jason mentioned with Medicare, how the rates will always go up. There is no statutory limit on it. Long-term care works exactly the same way. The other thing is long-term care, the type of policy you have to get to qualify for this tax deduction is a use it or lose it proposition for you. And what I mean by that is you either have a long-term care incident or you don't. You die of a heart attack suddenly, the insurance company will just say, thanks for the premium payments, policy's over. That's how it works. So when people hear that, a lot of times they think, oh, so the rates are going to go up, and nobody can predict how the rates are going to go up. So that's always fun. But 2 is it's kind of like your auto insurance, right? Someday you're going to stop driving. They're not going to give you anything back when you're done driving. So how do you manage that? Well, one way to manage it, sorry, my timer keeps going off on my light. One way to manage that is get what's called a hybrid policy of some kind. And that's where the long-term care is part of an insurance or an annuity that you purchase, because now the premiums are guaranteed. Both of those types of insurance products have a death benefit. And when you think about taxation, well, on a annuity, if you're married, you can a lot of times do something called spousal continuation. But on an insurance policy, when you die, the beneficiary generally gets that money income tax free. So I didn't have a long-term care incident. I died. My wife picked up a check for $500,000 income tax free. I knew what the premium payment was going to be. I knew that $500,000 was going to pay out regardless of what happened to me, right? No matter how I mean, if I was sick for 5 years before I died, I could have pulled money off that $500,000 to help pay for my expenses, right? When we do the planning on this, what we tend to look at is how do we fit this into the overall income structure? Because you got to pay the premiums on it, right? So how do we layer all that in? How do we make sure we understand, hey, you know what, if you do die at 82 and you didn't use any benefits, now your spouse picks up $500,000 income tax free, there's a positive impact on the plan. But if you got sick at 78 and the plan paid for all the expenses and you still got medical deductions, because of that, you may be eliminated your tax bill altogether. But at the same time, you got those chronic illness benefits income tax free. So deductibility of long-term care is great. When you look at Medicare deductibles, you can see those are always scary when people look at those. That's why you're going to buy a Med-Sup policy or a Medicare supplement when you get into retirement. And a great independent health insurance agent can help you figure that out. Guys, I'm gonna throw this out to you. Longevity planning. I know a lot of people are like, oh, I'm never going to live to 95. And then suddenly they're 85 and it's kind of starting to stare them in the face. Can you guys just, in the last, minute or so we have on this section, can you guys talk a little bit about longevity planning and just a couple ideas on, hey, if I'm at all worried about 105 for one of us, what are some basic things I should be thinking about?
Do you want to go, Jason?
Sure. I would say some basic things that you need to be thinking about if you think you're going to live to 105, like you're saying, is where's your income going to come from for that part? Because most people would exhaust the savings that they've had. A general rule is that you figure people are going to save and are going to have enough savings to cover themselves for 30 years, not 40 or 50 years, depending on how early they retire from that end. So you need to have a plan and a strategy that says, hey, I've got this design investment resource out here that's designed for my longevity if I go past the normal life expectancy. And that should be set up in a way in which it's going to recreate what you're losing in that spot because it has time to do it, right? If I'm 65 and I'm worried about if I live past 95, I've got 30 years for whatever that is to do what it's going to do to make sure I'm covered from that end. And that whatever that is will depend on the person, the circumstances, risk tolerance, all those things in regards to what would be best.
Okay. To keep us moving, Ken, talk to us about investment considerations for this year and beyond.
So these brackets have moved substantially over the last year or so. My biggest takeaway is not all investments are created equal, especially when you factor in the taxes on these accounts. So, Matt, if you can go to the right just a smidge more. There it is. Okay. So, as we were talking about, the first dollars you receive are tax free. Well, if you keep your taxable income on Social Security, that could be tax free. What I want you to see is that very top right number, 0%. If you have a taxable income below 96,000, so we'll just call it 100,000 for the year, 100% of your long-term capital gains, so stocks you held for at least 366 days and qualified dividends, you're not paying taxes on it. How awesome is that? Now, okay, you have taxable income above that. You're at $150,000. Well, it's at 15% is what you're paying taxes on the liquidations of those investments. That's a heck of a lot better than the 22 or 24% bracket, which you most likely fall in. The other thing I'd want you to strongly consider is yes, the taxes are lower, but what investment do you ultimately have? Some of the mutual funds and ETFs have how that fund manages its cost basis, what you start at and what you sell at, ultimately determines what your growth is at the end of the day. What that taxable amount is, again, falls into this category. So, not just managing your brackets, not just understanding where you're taking distributions from, be it IRAs or non qualified accounts, but then what those investments are actually invested in those non-qualified accounts can even further increase your tax efficiency and your growth even beyond. So the numbers have keep on going up, but really understanding your asset location and then how taxable that investment is year in year out makes a big difference on your bottom line.
So Ken, when you're talking about asset location, there's the concept or the idea, and hey, the cops are coming. That's great. There's the idea that there's buckets of money, right? And people have done behavioral finance, research on this, that people say, hey, that's the college fund, that's the vacation house fund, that's the car fund, that's the retirement fund, and all that. When we're thinking about buckets of money, though, a lot of times what we're thinking about are, I've got the taxable bucket, I've got the tax me later bucket, which is, like your 401k, and I've got the tax me never bucket, which is like the Roth and the cash value and a life insurance policy. Can you guys take a few minutes and just talk about, what would a balance between those three really look like? I got a taxable, I got one that I'm going to pay taxes on later, and I got one that I'll never pay taxes on. How should I spend those? How should I manage those? I've got this Social Security that's also tax advantaged, as at least what we're saying, right? How should someone think about trying to coordinate all that?
Yeah, so a big part of that really depends on what age you're in, right? So if you are 50 years old, you probably want to hold on to your tax me never bucket for as long as possible. Back to Jason's point about longevity, with just a 5% of your overall portfolio, if you just stash that away, the sooner the better to trigger income for you at 85 or 90 years old, that 5% of your portfolio when you're 50 will probably fully take care of whatever your needs are for the rest of your life. But again, what makes the most sense is that the tax me never bucket, the tax me now, or the tax me later. Same thing as when you're in your 70s, depending on what your RMDs are and the plannings that you've done in your 60 will really inform you on what's the optimal distribution strategy from your tax me now bucket, your tax me later bucket, or your tax me never bucket. And also, it ties back into your estate plan of what your goals are and what you're wanting to leave behind. Because some assets are better to leave to kids, some assets are better to leave to the church and charity. And understanding where you are today, majority of the people we meet, 80 to 90% of their assets are in the tax me later bucket. And how do we get that to 30, 30, 40? I think that's kind of where I'd like to end up personally myself. Go ahead, Matt.
So Ken, if someone was to take two things away from what you just said, because that's a lot to unpack, and it's good, right? I mean, it's good. But if someone was to take just two key takeaways out of that, what would you say that they should do?
Know what you're spending your money on and why you're spending it. And from there, that helps inform which account you need to be taking distributions. The second part is, where are you today? How much of your total net wealth, how much is of it in taxable, tax deferred, or tax free? And is that where you want it to be? It's typically a 3 to maybe a 10-year process to get your allocation to where you want it to be. But what's your plan?
Gotcha. Okay. All right, guys, closing thoughts, call to action. Closing thoughts. Jason, what's the one thing someone should be thinking about based on everything we talked about today? What's the one thing?
I think the one thing they should be thinking about is, do they really understand their tax situation? Have they gotten an analysis done where it's not from maybe a tax preparer where you don't understand what they're saying most of the time, where it can be in plain Jane language, like Ken's saying, where you understand, okay, this is where my taxes are. Here's where I'm currently situated. Here's what I can expect going forward if I don't make some adjustments that I want to change where I'm going.
So I'm going to quintuple down on that statement for a second. Jason is spot on, and that is something we do for people at Mission Financial Planners. We won't file your taxes for you. I'll tell you that right up front. We will not prepare your taxes for you. I'll tell you that right up front. We will analyze your returns and show you exactly what Jason just said. What is your tax picture? What is it really? And we will spend time with you to talk about it in a way that you understand it. Ken, one takeaway from you.
Taxes are here. Taxes are always going to be here. If anything, they're expected to go up over the next 30 years. So what are we doing to actively plan and not be reactionary to how taxes change in our future?
Gotcha. So tax planning. It's not what you have, it's what you keep. Okay. All right. So what I'm going to stress in just my final comments here, we covered a lot of ground today. Jason and Ken, thank you so much for your wisdom. The importance, I don't think I can stress enough the importance of a holistic financial plan. We're coming out with a book later this year where we're going to talk about the 5 key points you need to be looking at. So stay tuned for that. But those 5 key points, taxes is one of them. I'm not going to tell you what the other 4 are, right? You'll find out when the book comes out. But if you want to learn more, get a hold of us, right? You can go to our website, missionfinancialplanners.com. You can book a meeting. Hey, if you love Jason, if you love Ken, if you love me, which of course you love me, but it doesn't matter. You can book a one-on-one consultation with any one of us. Okay? Doesn't matter. We will make the time to talk with you and see, what's your question? How can we help you? What kind of planning could we potentially help you with? And that's what we're looking for. We're based in San Antonio, Texas. We work in 38 states, though. So if you're not in Texas, reach out anyways. Absolutely reach out anyways. Next podcast episode, we are going to talk about financial fitness. So it's kind of a segue, or it's a natural evolution out of this. We're going to drill in a little more on some of the key planning areas. That'll come out in later February. This should get posted first week of February, somewhere in there. So maybe late February, early March, you'll see that. But in the meantime, if you want to speak with us, Jason, what's your phone number? What's your direct dial?
It's
once again, 726-727-6583. You can always email him as well. You'll find his contact information on the website. You can also text him at that number. Ken, what's your direct dial? 82, same thing. His email address is on our website. You can also text Ken at that number. Feel free to call him. Even if you want to text him to say, hey, can we find a time to talk? We'll respond, right? My direct, 726-727-6581. My email is on the website as well. But thank you so much, everyone. This is our inaugural, and Ken, what's the name of it again? What are our 3 names again? Hey, it's the Oh Shucks Financial Planning. There you go. That's perfect.
Mission
Shucks.
Wealth.
Mission Wealth. Okay. All right. Thank you so much, everyone. We'll see you next month.